CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund.
Hello and welcome to CNBC TV 18's Women and Money series presents Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. I'm Sumaira Abdi. Today we answer the most asked question: how should you invest? SIP or lump sum? So join us as we discuss the advantages of SIPs, the factors to consider, and a whole lot more. And joining in to talk about just this is Rajalakshmi Rajesh, founder of Banconus. Rajalakshmi, thanks very much for joining in. And even though a lot of people think that SIP is the most basic concept, I think it's also a concept which has still not been entirely understood by a lot of people, and therefore becomes the most important first step in investors' journey with mutual funds. So first, let's start with what is the main distinction? What is an SIP? What is a lump sum? And what's the best way to go about both?
When we are talking of a lump sum or an SIP investment in a mutual fund, the fundamental thing to remember is that the underlying asset class is the same. So if you're investing in equity funds, whether through a lump sum investment or a SIP, you're subjecting yourself to the same risks and returns associated with that asset class. Only the methodology for the investment is different. It's thus the difference between doing a fixed deposit in a bank or a post office and doing a recurring deposit. So having said that, SIP has definitely advantages over a lump sum because of two reasons. The way our own cash flows are structured is very important. So most of us, when we are investing, we have periodic earnings. Either if we are working, we have our monthly salaries and bonuses which come in periodically, or we might have a rental income, or even when we are professionals or entrepreneurs, we have some most investors have predictable cash flows. And the methodology or the obvious method to deploy these cash flows is only through a monthly investment, which is what a SIP is. And especially when we are investing in equity markets, the most important way to navigate volatility, which is the underlying nature of the equity market, is through a recurring investment, which is what a SIP helps us to.
Rajalakshmi, is there enough evidence to support the claim that SIP actually works out better for an investor over the long term vis-a-vis lump sum?
So yes and no, because it's also a function of the time at which to enter a market. The returns are influenced by the time. So supposing you have made a lump sum investment and you have caught the market on the right side at a low point, or when the valuations have been lesser, then obviously a lump sum investment would give you better returns vis-a-vis a SIP, where you're not entering in one shot and you're investing periodically month on month or say quarterly. But the point to note here is we never know when the timing is right. We know it only in retrospect. I would never, if you take a recent example, 1 year back, everyone thought the markets were overvalued. It's not the time to get in because we had already finished 7 to 8 months of a rally in the market. So if I had had a lump sum, it is very difficult for retail investors to know in advance whether the timing is right or not. So that is the timing of the market. Since it is so difficult, SIP is an obvious choice because all the ups and downs over a slightly longer time frame are averaged out. That's what is rupee cost averaging. So even if the market goes down immediately after I invest, I have the next installment to look forward to where I will buy the units at a lesser price. So in a longer term, there is enough historic evidence to prove that SIPs, though may not give you higher returns, they help you reduce the volatility in your investment journey, which is a very, very important factor, because investing is about emotions. And suddenly you put, say, a lump sum amount of 10 lakhs and the market's correct by 10 or 15%, you would see it coming down and you panic and you might withdraw. Whereas SIP avoids this kind of a turmoil in your investment journey. It allows you to enter into the market in periodic intervals, due to which your entry price, entry timing is averaged out, and you make optimum returns through a SIP investment.
In fact, I had read this very, very interesting study by Morningstar India, where they had studied the preceding 10-year period, which ended in March of 2021. And they showed us how, over the last decade, the market has outperformed only 8% of the time. So, if you weren't already invested when that outperformance came, you would have missed it already. And I guess that is the logic of the SIPs to, ride out all sorts of market moves through that. But Rajalakshmi, is that really the purpose which SIP helps with, which is to just ride it out and therefore over the longer term compound your wealth?
What people generally don't realize is what is more important than intellectual effort is the emotional discipline. So this discipline is very, very fundamental because your rewards of compounding happen after. They do not happen in 1 year, 2 years, or 3 years. As when we say long term, most of us talk of 2 years or 3 years, which is not the case at all. When we say long term, the returns also are the highest after a 5 or 7 year period in equities, and also the compounding effect kicks in much later. But when it happens in geometric progression. So for that, for you to build a corpus which will compound very, very fast, and SIP is a very important route because, as we know, we have statistics to prove that the entry timing would change the entire return gambit in a lump sum investment. Say, for example, if you had invested exactly in April 2020, just before 2 years, your returns in the last 2 years would have been phenomenal. But who would have had the courage when everything was falling down around you in terms of health, in terms of economic crisis? No one would have had the courage to enter big time into the market. Whereas, even if you had not done that, if you had just kept on investing with some discipline, continued your SIPs, the returns that you're going to have at the end of these 2 years is still going to be very, very good. So that is why, since the timing of market is not within our hands, and SIPs also help you manage your cash flows better, it's always wiser to get into SIP, continue it with discipline, not be carried away by what is happening in the short term in the market, which will allow you to reap the benefits of compounding and also grow your long term wealth.
And, so we have established the fact that for a retail investor, SIP is the better route because it's very difficult to sort of try and time the market, which even experts struggle with. But, in the event that people do have lump sum money coming into them, should they look at perhaps a systematic transfer plan and thereby convert that lump sum also into SIP to invest it into the market?
If I have a big corpus, it might not still be advisable or wise to deploy it in one go. So that is when an STP becomes a substitute for an SIP. So we decide how much exposure we should take into equity, and we invest it, because in fixed income funds or debt funds, actually the returns are not as volatile as in equity. That is why we park the money in money market funds or liquid funds. And instead of a SIP wherein the money moves from your bank account month on month, we do the same thing by moving from a money market fund or a liquid fund to equity funds over a period of time. Now, how much can that period be is a function of the amount of corpus that I have, the amount of allocation that I already have to equity. But anything from 6 months to a year is again a period that we advise for STPs also. Even when you have a lump sum investment, a significant corpus, say if it is higher than 5% of what you have already invested or 10% of what you already invested, your overall net worth or your overall exposure to markets, it is still ideal not to put it in one shot into the markets, but to take it as a periodic investment using the STP route.
Rajalakshmi, once people are convinced about choosing the SIP route, a lot of questions come up around, what is the ideal periodicity of this SIP? And most common, of course, is monthly. But we know that in some cases, bi-monthly, weekly, maybe even daily SIPs are possible. Is there any science behind what should be the periodicity? And even when people, suppose, have chosen monthly, they debate whether the date should be the 1st of the month or the 5th of the month or the 10th of the month. So, I just want to understand, is there any science to this, or, just pick a date and go with it?
The most common is monthly SIPs. What I would recommend is, the most important advantage of SIP investing is the flexibility that it offers today. I mean, over the years, The flexibility and the structure is not rigid at all, which means you can choose the dates, you can choose the amount, you can choose to invest on every day. But I think from the perspective of keeping things simple, keeping things easier for you to track, it's easy to choose 3 or 4 dates across the month. It need not be daily, that would be too much, because everything is possible. You can do even 1,000 rupees every day, choose 30 SIPs, or choose weekly, choose daily. But from the point of view of kind of keeping the paperwork, the amount of transactions, everything simple, I think the marginal utility or the incremental benefit that you will get is very, very less. So I think going for 3 dates in a month and splitting up your entire SIP amount over those 3 to 4 dates would be an ideal choice for an investor.
Rajalakshmi, what are the various kinds of SIP? I mean, can you sort of make alterations once your SIP has started? Can you change the periodicity? Can you change the kind of SIP that you have?
Yeah, so as I mentioned earlier, the biggest advantage today that the SIP investment route offers in mutual funds is the flexibility associated with it. So when I say flexibility, what I mean is the amount of investment can be as low as 500 a month, but ideally we would recommend it should be a meaningful amount to make a difference to your wealth creation journey. So anything, I mean, I would recommend 20% or 15 to 20% of your post-tax income can be comfortably invested in SIPs. Now the amount can be you can start with a small amount. It's possible to top up your SIPs. What it means is, supposing you get an increment, you've been doing a 20,000 or a 30,000 SIP, at any point of time, you can increase the amount from 10 to 12,000 or 15,000. So top up SIPs are possible. Again, supposing you're looking at, say, 3-4 months of some higher expenditure due to which you may not be able to service your SIPs, though we recommend that you always look at your savings as your first expenditure and stay disciplined. But just in case there are some circumstances we are not able to fund your SIPs, then there are also mechanisms to pause your SIPs for a temporary period for 3 months or 4 months, to pause your SIPs and then resume it later. Or even the methodology, I mean, the process for stopping an SIP for 1 year and then starting are all very, very mechanized, automated processes which offer maximum flexibility and liquidity to the investors. So you can choose to do whatever you want in the SIP route of investment. And the best part is you don't have to lose sleep too much over these decisions, because they happen over a period of time painlessly, and it also instills tremendous discipline in your investing journey.
Rajalakshmi, are there cases where the combination of SIP along with lump sum investing may work out better than just using the pure SIP route?
When we commit to SIP, we commit based on certain factors or certain predictability of our earnings and cash flows. But it might so happen that we might have some surpluses periodically also, not because of any major event that's happening, but also because of some bonus that might got, or some overall savings. So a combination, whenever you decide your overall, keep an eye on your overall asset allocation to equity, and within that gambit, apart from your SIP, it makes tremendous sense to top up your investments with periodic, especially two reasons. When you have a corpus is one thing, and supposing in a particular year, once in 3 months or 6 months, there might be a short-term window of opportunity that the markets offer. Because of certain reasons, they might have corrected or they might have fallen. In order to capitalize on those windows of opportunity that you get, topping up your corpus with 1 or 2 lump sum investments also makes a lot of sense. So that would be the ideal mix for you to, you have your discipline through your SIP investing. You don't have to perfectly time the market. But having said that, as and when there is a short-term window, the markets have corrected for 5%, 10%, and you also are sitting on a small corpus which is building up in your savings bank account, it makes sense to top it up so that your contributions are continuously increasing and you reach your goals much faster.
Rajalakshmi, thank you so much for joining in and to explain this topic in such detail. So thanks very, very much indeed. With that, we're going to wind up on this short episode. I hope this has been a learning 15 minutes for you. And if you have any questions and comments, we look forward to hearing from you. Thanks very much for watching. Stay safe.
CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.